I want to stick with the Fed's stress tests for the banks now and bring in Fred Cannon. He is Global Head of Research at KBW, a Stifel company. Fred, good to see you here. You had a chance to look over these results. Any surprises in there for you? What stood out the most?
Well, the biggest thing that changed the most is the Fed shifted from a process where they look at stressing capital to determine payouts of dividends and share repurchases to focusing on payout ratios, earning the dividend. And that's a major shift in the thought process. And so as we think about these stress tests, we have to change our thought process to really focus on those payout ratios in terms of who is at risk from the Fed moving forward. The second issue that stuck out, as Brian suggested, is the Fed split on this. There's a significant portion of the Fed who thinks dividends should be suspended in total.
Fred, help investors understand this. If banks are not able to raise their dividends and you have a low interest rate environment, why put any money to work in these names at all?
Well, that's a fair question. I think there's a few areas where I think there's still a lot of value in this group. Number one is that, remember, this is a pro-cyclical group, and that as the Fed has indicated, when we emerge from this, there will be dividends, there will be a lot of earnings. We calculate, even in the US, if we have this low interest rate scenario for an extended period of time, our banks aren't going to be under the stress in terms of earnings and profitability that we see in Europe and Japan. So there's definitely value in this sector. They're a key component of the economy, and they're cyclical. So I think for investors who want to see opportunities, value investors, it's a group that people should certainly keep on their radar screen and certainly see some opportunities in. Also, selectively, we found some banks are in very good shape in terms of dividend payout. For example, the trust banks, Bank of New York and State Street, Northern Trust. When you look at that dividend payout issue and the stress tests of those banks look very strong in terms of being able to continue to pay the dividends.
Fred, it's Brian Chung. What was interesting to me about the Fed release is that the dividend and the buyback restrictions are only for the third quarter, but the Fed said it could extend that if it wanted to. It could even do more stress tests if it wanted to, as senior Fed officials told us. I'm wondering, what type of risk do you think that presents to the bank stocks in the near and medium term future, as this regime might continue, especially as we know the COVID-19 crisis does continue with more states facing higher cases?
It just means this dividend issue is an overhang on the group indefinitely, because we're going to go quarter by quarter. So that's number one. The second issue is that we have to recognize there is some politics here, and that is that Lael Brainard was appointed by Obama. She's an incredibly talented governor, and so that suggests that if we get into, in many ways we pushed some of the dividend issues post-election. And so we can't ignore the election in terms of looking at the bank stocks.
Should the American public be concerned at all about the health of banks if this recovery is much slower than we had imagined? We were talking about a V-shaped recovery. Larry Kudlow coming out this week and saying that's still very possible. But what if we get that U-shaped recovery, a W-shaped recovery? Are the banks still well capitalized? Is that what these stress tests showed us?
Thanks for asking that, Alexis, because at the end of the day, that is the core issue. And the answer is they are well capitalized and in good shape. Most of these issues about dividends and capital are about just being extra careful about these situations. We have to look at what both the bank's capital position coming into this, 3 times the strength it was going into the great financial crisis, and also what the Fed has already done to backstop the banks in terms of the lending programs they have for all kinds of assets. The combination of the Fed actions so far and the strength of the bank balance sheets, in our view, means that we aren't facing the type of financial crisis that we had back in 08 and 09. Obviously, we're facing a very difficult crisis, but the banking industry, between what the Fed is doing and what the banks have done themselves, we believe is in good shape to get through even a U-shaped economic recovery.
All right, we're going to leave it there. Thanks so much for joining us this morning and shedding some light on those stress tests, Fred Cannon. We appreciate it.
Great. Thanks for having me on.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.